My name is Jake, welcome to the channel. In today's video, I want to share with you why I chose dividend investing over the 4% rule to reach early retirement. About 8 years ago, I discovered the FIRE movement, financial independence to retire early, and I was asking myself, do I want to go the traditional route where I pursue the 4% rule? I was also considering reaching this goal of early retirement with dividend investing. And in this video, I want to share with you some things that I considered and some things that helped me. And if you're new to this and you're kind of in a similar situation like I was years ago, hopefully by watching this video, it'll give you a little bit more insight into some of the pros and cons of both of these approaches. So in today's video, I'm going to cover 4 things. First, I want to briefly touch on the S&P 500 dividend growth historical chart versus the price chart over time. And then I'm going to talk about the pros and cons of both dividend investing to retire early, as well as the pros and cons with the 4% rule to retire early. And then lastly, I'm going to share with you some personal reasons of why I chose to pursue dividend investing over the 4% rule to retire early. So regardless if you want to retire off of dividends or off the 4% rule, you're going to need to work really hard or be really creative to make money in the first place. And there are many different ways that you can do that. For example, you could work in construction, working really hard, or you could make cat videos online to make money. And it could look a little like this.
Who's it? Are you gonna stretch your leg out? Oh, yeah. You stretch it out, right?
Oh my gosh. I watch one cat video and then the algorithm thinks that that's all I want to watch. And now I just only am getting cat videos on Instagram and on YouTube. They're probably right because I keep clicking on them. But yeah. Oh my gosh. Well, anyways, I want to start here and I want to show you something that might be really interesting if you've never seen this before. This is on Guru Focus, the website. But anyways, what I want to show you is the difference in the growth of the S&P 500 compared to the dividend growth, and why it's important to not just focus on one specific piece, but there's 3 things that I want to show you and I want to highlight here. So this is the overview of the S&P 500 since 1957, since the index looks the way that it does that we know today with 500 companies. This right here is the S&P 500 dividend per share of this index. And you'll notice with both of these charts, they're up and to the right since 1957. So dividends per share and the S&P 500 index itself. So the first thing that I want to show you, if you look at both of these charts, they're pretty similar, but if you dive a little bit deeper, you're going to see something a little bit different. So first off, if we just look at the overall, percentage growth of both of these, the share price itself has grown 11,000% since 1957. Now, if we do the exact same comparison with the dividend growth, you'll notice that the dividend growth has just grown just under 4,000%. So about a third of the share price. So if you just look at this objectively, in terms of a total return, you were better off focusing on the total return, that being the share price and the dividend, and not just focusing on the dividend. But it's important that you know the facts. If you're a dividend investor, you're likely going to underperform the market if your sole focus is just on the dividend alone. The dividend is just one part of it. Okay. And it's important that you educate yourself and understand that if you watch a YouTube video where somebody is just praising and talking only positively about dividends, I'm sorry, they're doing you a disservice. They're not giving you the full picture. Dividends are great, but there are some drawbacks that come with them. If we look at that on just a pure percentage basis, you've gotten more growth from just the share price. Okay, so that's an important piece to understand. But if we go back and we look at the index itself and we look at this year over year and see what the chart looks like then, it kind of paints a little bit of a different picture in terms of what it's like to live in the moment while investing in the S&P 500. Because hindsight 2020 is easy. Yeah, just invest in the S&P 500 and it only goes up. In real time, you'll notice that the S&P 500 since 1957 has been in the red year over year about 30% of the time. So if you're holding just the S&P 500 as an example, you're in the red 30% of the time. So that means there's quite a bit of volatility in an investment like the S&P 500 as an example here. Okay, so out of the 67 years, about 20 of those years were in the red. And when we compare this with the year-over-year dividend growth of the S&P 500 since 1957, you'll notice that less than 10% of those last 67 years, you would have a dividend that has decreased. So a big highlight here is the volatility and the emotional roller coaster that comes with retiring early, investing in a dividend stocks or a dividend strategy versus the traditional FIRE movement with the 4% rule. You're going to have, yes, a lower total return over time if you're just looking at the charts here, but you're going to have a lot less volatility and fluctuation as well. Okay, so it's important that you see both sides of this, the percentage growth over time as well as the volatility, and see what's important to you. What do you value more? Because at the end of the day, not everyone is the same, and not everyone deals with market volatility and their emotions the same. Now let's talk about some of the pros and cons with dividend investing to retire early. The first pro is you're going to have less volatility. As we saw in the charts before, that there is going to be less volatility in a dividend-focused retirement because dividend stocks are generally seen as a defensive stock in down markets. When the market is going down in more volatile times, investors generally will flock to safety, and dividend stocks are generally seen as a safer or a safe investment. And, I would also put in there that, when you're thinking about early retirement, you probably don't want, a lot of the volatility and a lot of the stress. And early retirement is meant to be stress-free. And so having less volatility though you're probably going to get lower returns over time because we saw, the total returns were higher with the market itself versus just focusing on the dividend, you're going to get more volatility, and it's hard to put a value, a price tag on the emotional piece of this because when you're living in a volatile market like we saw in 2008, 2009, in 2020, it's a lot easier said than done when you're not in the heat of it. So don't underestimate the power of a low volatility investment approach. The second pro that comes with dividend investing is you have no sequence of returns risk. Now, when we get to the 4% rule, this is going to be a major one. This is a big one, meaning that there's no risk of timing when you sell out of your shares. If you're, picking a time each year to sell off 4% of your portfolio, if you're in a down market like in 2020 or in 2022, where the market went down almost 30%, and the NASDAQ went down even more, it can be very risky to your overall, goals of just living off of your portfolio. So with dividend investing, you don't have any of that. So let me give you a personal example to humanize this. My parents are thinking about selling their house. They've lived in this house for over 30 years. This is the house that I, grew up in, and they're thinking about selling it, and they've had it for over 3 decades, and they've held it for 3 decades. And now they're deciding to sell it today, now in 2024, when interest rates are at a decade high. And so regardless of holding it for 3 decades, they can still get the timing off. If they would have sold it in 2021, they would have been geniuses. But now in 2024, with interest rates so high, you just can't time it. Even if they held it for 3 decades plus, you can get unlucky with the timing. And with dividend investing, you don't have that. You have no sequence of returns risk because you're not selling your shares. The third pro that comes with dividend investing is you're creating generational wealth for your family. Because you're not selling off a percentage of your portfolio each year to live off of, but rather you're living off of the investment itself, you're not going to dwindle away your net worth, and you're going to be able to pass that on to your family or to donate the money to a cause that's important to you. And so with dividend investing, it's a great way to create generational wealth for you and your family. So now let's talk about some of the cons with dividend investing to retire early. The first one is that it's more difficult to plan around with taxes. And this can have a few different implications. For example, if you have different investment types like covered call ETFs, REITs, some of them are going to grow faster than others, and you don't really know what you're going to make in a year until the last day of the year. And so when you're planning for maybe subsidies for ACA, for your healthcare, it can be a little bit more difficult because you just don't know what you're going to get paid. You're just, kind of doing a projection. Whereas with, the 4% rule, if you made a lump sum sell in January, you know that that's what you're going to make, plus or minus, the dividends that come from the S&P 500 or the total U.S. stock market. So it's a little bit more difficult to plan around for taxes. The second con is that dividends can get cut. They're not guaranteed. Great companies can go out of style. Great companies can be disrupted. And so, you look at Walgreens, for example. Walgreens had a great dividend track record, and what happened now? So dividends are never guaranteed, and that is absolutely a con that comes with dividend investing. The third con, and probably the most important, is that especially if you're retiring early in your 30s or 40s, you really early, your upside is limited in a bull market. So you're not going to have as much market participation in, the high flyers like Nvidia, Tesla. You're not going to participate as much in the growth of the market through those type of companies because you're just simply not allocated to those companies, or you're not overweight in those companies. So your upside, and we saw that in the charts earlier, that your growth, the growth potential, you're sacrificing the growth for the lower volatility and the little bit more consistency, with the dividend versus kind of the boom or bust with the growth of the overall market. All right, now let's talk about some of the pros and cons with the 4% rule to retire early. So some of the pros are, for example, tax planning, especially with, healthcare subsidies. Tax planning is significantly easier with the 4% rule, assuming that you're more so lump sum selling instead of like more monthly or quarterly. Generally, I would assume that you would do it more so on an annual basis, specifically for, the healthcare subsidies. That just, it makes a lot more sense to me. So tax planning can be a huge drag, and it can be a huge issue if not done correctly. But one of the pros that comes with the 4% rule is I believe you have more control over your tax planning. The next pro is you have full participation in the growth of the market. So it really is a true survival of the fittest if you believe in efficient markets. If you're investing in the total U.S. stock market, as an example, you are getting the best of the best. And as companies, growth companies in particular that are not paying a dividend, you're going to get participation in that growth, and you're going to see the value of your portfolio grow. Whereas if you're just focused on a dividend index, or an index that tracks a dividend or a different dividend metric, you're not going to get those up and coming, high flying growth stories like a Tesla, as an example. And so there's not very many examples of that, but they can have a major impact on the overall market and total returns. So full participation in the growth of the market as a whole is a definite pro of the 4% rule. And then the third pro is that it's arguably easier to plan if you simply aim for 25 times your annual expenses. The overall planning of the 4% rule, though you do have to plan for sequence of returns, you can look at it from different perspectives in that way. I think overall, it's a little bit easier and a little bit more straightforward to plan, to retire early with the 4% rule. Now, obviously, you're going to have some of those things that come with that, a little bit more volatility. But overall, the planning that goes into retiring early, I think, is a little bit easier with the 4% rule. So now let's talk about some of the cons of retiring early with the 4% rule. The very first one is the sequence of returns risks. If you're selling at the wrong time, or if you're selling in a bear market, that's going to have a major impact on the trajectory of your portfolio. You may have to cut back. Instead of selling 4% one year, you might have to sell 3%, and you might have to adjust. That might not be the end of the world, but if you're cutting short, you're cutting it a little bit tight, you might have to fall back or have a plan B. So the sequence of returns risk is probably the most important con when it comes to the 4% rule. The second con is it's kind of like that boom or bust lifestyle. If the market's doing well, you're doing well. If the market's doing poorly, you're doing poorly. In a bear market and you see your portfolio go down 30% and you realize, oh, we're not going to be able to sell 4% of our portfolio. We're only going to be able to sell 2.5%. So kind of that, and that is if you don't have like a safety net or an emergency fund of 1 or 2 years just in cash. Like if you don't prepare for it properly, that can have a huge impact on your lifestyle. And everything can be dependent on what the market is doing. So that can be definitely a con, especially if you're cutting corners and you don't have a safety net and you're not planning appropriately. Now, the third con, it kind of ties more into generational wealth, but the question is will you be able to leave anything behind to your family, or will you run out of money before you end up passing? And so that's something that's always on someone's mind if they're thinking about the 4% rule. Now, this is not going to apply to everyone because not everyone has kids. Not everyone, looks at it from this perspective. But I think, when you think about generational wealth and you see the struggles that people are facing today, how money doesn't necessarily buy happiness, but it really gives you a head start in life if you don't have to worry about the necessities in life, like a roof over your head, or where's the money going to come from for your next meal. Setting your family up for success in that way can be really, really beneficial. And you see it in those families today who don't have that and who are struggling, and really the power of generational wealth. And I think a lot of people are waking up to that. And I think for that reason, that is one of the cons here for the 4% rule. So lastly here, I want to share with you why I chose dividend investing over the 4% rule to retire early. When I first found the FIRE movement, I was intrigued by the idea of not having to, have a 9-to-5 job for the rest of my life, not having to answer to a boss or, be on someone else's terms, be able to live life how I see fit and how I choose, and being free. And both of these options, dividend investing or the 4% rule, could have worked for what I was trying to do. What's so interesting about this whole thing is there's not a one size fits all. Some people are much more risk averse. Some people look at historical charts and say, well, duh, just do it this because, they kind of have, recency bias, or they, confirmation bias by just looking at a chart. A lot of people underestimate the impact of emotions and how emotions really impact consumer behavior. So the first reason why I chose dividend investing over the 4% rule to retire early was that sense of control. I felt like if I could pick the investments, the ETFs like SHD, DJRO, etc., and focus on the dividend and the dividend growth, I felt like I had more control over the outcome of what I was trying to accomplish. I didn't want to 10x my portfolio. That was never my goal. It was more so focused on a steady, consistent dividend growth over time. And that's what was important to me, and less of the boom or bust type of retirement. Retirement for me is meant to be stress-free. It's not drinking martinis on the beach. It's not having to worry about my investments, not having to look at the market and see, we're going into another recession. It looks like we can't, afford meat. We're going to have to just have rice and beans, right? Like, I never wanted that. And I'm not saying that that's necessarily how it is with the 4% rule. But for me, I didn't want this boom or bust type of retirement. I wanted to have a little bit more control. And that's why I use the word, the sense of control. Because at the end of the day, I can't control everything, but I feel like I have a little bit more control over the outcome. The second reason why I chose dividend investing, it kind of ties into the first one, but it feels like I can focus more on the dividend growth of my investment instead of the share price. So instead of timing when I sell the shares in retirement, kind of ties into the sequence of returns risk, But it's not me focusing on when I'm going to sell, but rather focusing on the growth of my portfolio through the dividend growth and the growth of the income. If I'm holding on to my shares, if we're in a down year, if we're in a recession, so be it. That's fine. I'm not going to sell my shares unless they cut their dividend, but that's something completely different. In a down market, you look at companies like Coca-Cola, companies that have grown their dividend during recessions. Like that's really what I'm focused on. And so focusing on the dividend growth instead of the share price is one of the big reasons why I chose dividend investing over the 4% rule. The last reason why I chose dividend investing over the 4% rule is one of the most important for me, and that is to create generational wealth for my family. Now, we only have one boy. His name is Lucas. We don't plan on having more kids, and so we plan on leaving everything to him. Things could always change from now until then. I mean, I might want to, donate money to a charity or something that's important to us. But having the ability to share our wealth with our family and for causes that are important to us is really a big driver for dividend investing. We learned all from the Egyptians. It doesn't matter how much gold you have. If you're buried in a pyramid, you're not taking that gold with you. It stays here on earth. Being able to leave that money behind, that hard work and the sacrifice that I sacrificed in my earlier years, to be able to pass that on to my son and to other causes that are important to me, I really value that a lot. And that's not going to be something that, everybody values. Some people, they want to die with nothing, with zero. And more power to them. That's cool. But for me, I don't know. I just always valued that I wanted to be able to pass something on to my son. And that was a big motivator for me. And that was one of the reasons why I chose dividend investing over the 4% rule, because I believe with dividend investing, I'll be able to preserve more of our wealth and be able to pass that on and do good with the sacrifices that we made earlier in our years to be able to do good for others in the future. Thank you so much for watching, everybody. I hope that the video was helpful. I hope you learned something new. I hope this opened your eyes to, if you're in a similar situation, thinking about which approach is right for you. There's no one size fits all. That's the beautiful thing about investing. It's a beautiful thing about being on this earth is many different paths can lead to success. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.